Good morning, ladies and gentlemen. Welcome to IGE Webinar Forum. Today, I'm so very excited to have a special guest speaker, Mr. Tai Hui, a leading and internationally recognized expert on the financial market, economy, and investing. He will be joining us live from Hong Kong to discuss the recent turmoil or turbulence on the global financial markets and the repercussions of so-called King Dollar. Tai will also talk about the issues relating to whether or not resurgence of 1997 Asian financial crisis be likely or not. With over 20 years of extensive experience, Tai, a graduate of Cambridge University, is currently Managing Director and Chief Market Strategist at JP Morgan Asset Management, responsible specifically for Asia. He's known for his authoritative views actively shared on international media, such as Bloomberg and CNBC. Now, please allow me to take this opportunity to say that today's event is the first of the two webinar series we dedicate to the discussion of the international economic and financial threats we face these days. Today's first one with the JP Morgan's Tai is more for market-oriented perspective. Whereas the next one that is scheduled for October 20th, that is about 2 weeks, exactly 2 weeks later, will explore more policy-oriented perspectives with Harvard professor Ken Rogoff. You should know him. A former IMF chief economist and the author of the best-selling book entitled "This Time is Different." And we'll hear directly from him about whether the current crisis is different from the previous ones or not. With further ado, let's welcome Tai for about 20 minutes opening speech, which will be followed by a Q&A session. We have 3 outstanding designated discussants and open discussion between Tai and myself. Tai, floor is yours. Welcome.
Great, Dr. Jun. Thank you very much. First of all, I'd like to thank you for the honor and the invitation to allow me to share my views with the IGE members. Just as my compliance team tell me, I have to stress this is my personal opinion. Independent, unbiased opinions of markets and economy does not necessarily represent JP Morgan Asset Management's view. So as you rightly mentioned, obviously we've gone through quite a challenging 2022. Challenging for the markets because it's the first time in a very long time where both equities and fixed income have delivered very poor return. In fact, we have to go all the way back, 50, 60 years to see something equivalent. I mean, obviously, we've been through markets where equities delivered very poor return, but for both equities and government bonds to be down 10, 20%, frankly, this period of the last 9 months have been somewhat unprecedented. So what I would like to do today in the first 20 minutes or so is to walk through a few topics. First of all, my view on what's happening with the global economy, especially in the context of central banks tightening. Number 2, and perhaps closer to home, obviously, what does that mean for the Korean won, which again, we've seen quite a sharp depreciation. And I think in a way, people are asking the question, is this a repeat of the Asian financial crisis? To me, it's a very healthy question because only if we forget about these crises, I think these crises will occur. So if you think about what Korea went through in 97, 98, if you think about what Southeast Asia markets like Thailand, like Indonesia went through in the late 90s, I think one personal observation is that many senior officials today, they were the junior officials 20 years ago, 25 years ago. So I think the good thing is that they will not be complacent about the global environment today, which, don't get me wrong, it is very challenging, but I would also have some positive hope that we are asking the right questions as we are today, as Dr. Jun rightly asked just now, are we seeing any cracks in the economy, any cracks in the financial markets? Okay, so if I may share my screen, just to share a couple of slides with you in terms of what I think will be important. Okay, so so before I talk about the market itself, I just want to share a few thoughts on the global economy. So ultimately, I think what we are facing right now is an unprecedented period of high inflation, and a lot of that is brought by a combination of factors. Energy prices, some of that is because of the Russia-Ukraine crisis, the COVID recovery. So European, US consumers, they went back to spending, and that created very strong demand, but with supply chain issues, both in the goods sectors, but also more importantly, in the service sector. And of course, if you look at the US and Europe in the past 2 years, they have applied very aggressive fiscal stimulus to their economy as well. And that obviously fueled the inflation problems that we have right now. So what you see here is that central banks in both the developed world and in emerging markets have been aggressively raising interest rates. So what you see on this page, hopefully you can see the screen. On the left-hand side is the number of central bank policy change, since 2008. And what you see here is that both developed markets, the gray bar, and emerging markets, the purple bar, the number of interest rate increase so far year to date in 2022, it's by far the most aggressive, most synchronized policy rate increase that we've seen for a very long time. And this does not even take into account of the fact that many central banks, including the Federal Reserve in the US, are raising rates by 50, 75, even 100 basis points to make sure that their policy rates are back to neutral quick enough in order to cool down inflation pressure. On the right-hand side, what you see here is the progress of interest rate increase. The blue dot is where we were at the end of September for central banks around the world. The gray dot is where we were at the start of 2022. And the purple dot, we borrowed the investment bank, JP Morgan Investment Bank's forecasts. And what you see here is that we are not done in terms of interest rate increase between now and the first quarter of 2023, i.e. 6 months in the future. So what we have here is that central banks, everybody recognizes that inflation is the bigger challenge right now, and they're all gearing towards high interest rates. Now, the reality is that you cannot cool down inflation without cooling down demand. And therefore, I think in the next 12 to 18 months, you are likely to see a much weaker global economic growth. And this is part of the reason why we've seen a strong dollar. We've seen challenging investment environment, both in South Korea and also in Asia Pacific and globally. And I think that is something that we have to bear in mind, is that you cannot engineer lower inflation without cooling demand. Now, we do think, or at least I do think, the recession risk in Europe and the UK is high. And which means for many export-oriented economies, including South Korea, including Hong Kong, including Taiwan, the outlook on the export front is challenging. And we're already starting to see some deceleration in exports. Now, for the US, which is the key of everything, obviously the Fed would like to avoid a recession. But as I mentioned earlier, cooling inflation and cooling demand are two sides of the same coin. And what we've seen from a financial market indication is that we are probably, we have about 80% probability of the US falling into a recession in the next 24 months as a result of the Fed's tighter policy. On the fiscal side, I'm assuming after the midterm elections in November, the Democrats is likely to lose perhaps the House, maybe even the Senate, which means President Biden is going to find it very difficult to implement expansionary fiscal policy. If you look at the US, corporate spending, investment typically triggers a recession. If you look back to the last 12 recessions in the US, 11 of them, majority of the slowdown came from corporate spending and the housing market. Only one, the COVID pandemic, was where household spending were responsible for a bigger part of the recession. So if I'm going to look out for recession risk in the US, I will pay a lot of attention to corporate spending in the US, because typically companies are much more sensitive to interest rates. But I think another point to bear in mind is that we should not neglect the fact that housing market in the US is also under threat. This chart on the left-hand side, the purple line is 30-year fixed rate mortgage. And you can see in a very short space of time, the borrowing cost, if I want to take out a mortgage today, is almost 7%. And at the start of this year, it was around 3%. So what that means is that for homeowners who've locked in 3%, they are fine, because for the next 20, 30 years, they are going to pay 3% for the mortgages. But if I buy a home today and I take out a mortgage, I need to pay 6, 7% over the next 30 years. And not surprisingly, that is going to cool down the housing market very significantly. But there's going to be a delayed effect, because again, existing homeowners, they're fine. New home buyers, they have to face a much higher borrowing costs. So I think the problem with where the Fed is right now, if you listen to Fed officials, they say, look, the economy is fine. And that's true, because if you look at the job market, the job numbers this week, the US job market is still in pretty good shape. The economy is still growing. But I think the risk is, with such an aggressive interest rate increase in the past 9 months, a lot of the impact from higher rates will come later. There's always a lag effect. The analogy I often use is, imagine if you are trying to pour ketchup or tomato sauce from this old school a glass bottle. You can smack it, you can like really tip it and shake it, and the tomato sauce takes a long time to come out, and sometimes too much comes out. In a way, the Fed hiking cycle is very similar. The Fed can hike rates aggressively, and there may not be a reaction in the first 6 months, 9 months, even 12 months of the hiking cycle. But once the corporate sector the high rates start to impact the corporate sector, start to impact on the housing market, I think we could be looking at quite a challenging growth environment in 2023 for the US economy. Now, on top of that, I think the recent experience in the UK also, it's an important reminder that we need to be very mindful of some of the hidden danger and risks in the financial sector. So for example, I'm not going to go through the whole situation in the UK. I'm sure you're familiar in the past few weeks. Essentially, the government rolled out a very aggressive tax cuts without a clear way of how to finance it. Financial markets lost confidence. Government bond yields rose. The British pounds collapsed. And that forced the government to make a U-turn on its tax cuts plan. But one thing that came out was a very ordinary, very common strategy used by pension funds in the UK to match their assets and liabilities were not able to withstand such a significant shift in bond yields. And therefore, the Bank of England needs to step in to intervene in the markets. Now, the good news is, I think the situation is now under control. But this episode, again, reminded us that there could well be some cracks or pressure points in the financial markets and the financial systems that we're not fully aware of, that could potentially, again, create stress in the markets and force central banks and the authorities to change their tactics. Now, to be very honest, I do not know what could be the next shoe to drop. I think, we need to continue to monitor, but I think, we should not assume because the financial markets today is in stable shape or the economic indicators are still okay, that's what's going to happen over the next 12, 18 months. I hope that's the case. I hope that we do get a more stable, a shallow recession in the US, but at the same time, we should not be complacent of some of the risks in the economy. And of course, weak economic growth, tough time for the general public. What does that mean for populist policies? We saw that with Italy, where a populist government has come into power. We could, again, see a shift in US sentiment after the midterm election. So again, another thing to bear in mind is what does that mean for policymakers and government officials when the economy is in recession, when people are struggling to pay their heating bills? That could, well, again, be some political shifts to come. All right, so let's come back to the markets and, let's see what is that telling us. Now, as I mentioned earlier, we've had a really difficult 2022 when it comes to equities and fixed income. The S&P 500 is down 25%. If you look at the fixed income market, many of the corporate bond markets are down 15, 20%. And that creates a lot of pain, a lot of problems for investors. The dollar has been very strong, a topic I'll come back to in a second. Are we done with the market correction, or is the market being too pessimistic? I would argue, well, first of all, that depends on where you are. If you look at Asia, if you look at South Korea, I would argue that the market is probably pricing in a lot of the bad news already. I think I'll show you that in a moment. But if you look at the US, I would argue that the market is still a little bit too optimistic of where things could be. So for example, again, on this page here, you look at the left-hand side, the red circle, the US corporate earnings market consensus is for 2022 to grow at about 8% and for 2023 to grow at about 8%. In my view, that is too optimistic, especially for 2023, because companies in the US today are facing significant margin compression. And also, if the economy does turn into a recession, corporate revenue growth is also going to slow down. So I don't think you're going to get 8% in 2023, which means the market will still need to adjust. So overall, if I look at our investment recommendation, is for investors to still focus a bit more on fixed income rather than equities, at least for a bit more of the bad news to come through. If you look at Asia Pacific, 2022, minus 8%, 2023, plus 7%, I actually think that's reasonable because for 2023, despite the challenges globally, we should not forget the fact that, we are seeing some economic reopening. If I look at Asia, if I look at Hong Kong, I look forward to visit Seoul soon, maybe before the end of the year, if not 2023, after having not been visiting for the last 2 years. Many Asian economies are starting to reopen. And we are probably 12 to 18 months behind the US and Europe. So from that perspective, I think the domestic demand recovery can provide some offset to what's happening in exports. And more specifically for South Korea, if I look at the South Korean equity market, 45% of the MSCI Korea index is in information technology. Now, yes, IT and communication services is a big part of the Korean economy, but it's not half of the economy. So in that sense, we often will argue that we focus more on corporate earnings, not so much on macroeconomic growth, because there's always some disconnection between the two. So I would not overinterpret what the market is telling us or market is doing versus where the economy is happening right now. Okay, let's come back to the question of currencies. We've seen a strong dollar. And for those of you who are familiar, the strong dollar typically comes for two reasons. One is interest rate differentials. So when the Fed is raising interest rates aggressively, obviously, that benefits the dollar. The second point is when the dollar is strong, it typically reflects, investors are concerned. Investors are worried there is risk aversion in the market. So at this point, the Fed is raising rates, and also people are worried that the global economy is going to slow down, may even fall into recession. And that provides a very powerful combination for the US dollar to strengthen in 2022, and probably over the course of the next several months. Now, again, I've highlighted South Korea here, 16% for the won depreciation against the US dollar. Now, I think there are a couple of things here. First of all, Korea is not alone in seeing such aggressive depreciation. If you look at Japan, if you look at Taiwan, if you look at Thailand, many Asian economies have gone through similar depreciation. So it's a reflection of the strong big dollar index, not only about problems or risks in South Korea. So that's one thing. Everyone is having the same problem. The second point is, because South Korea, it's the export composition and a lot of our economic performance is very similar to, for example, to Japan. So in the Japanese yen, you see that 20% depreciation is quite natural for the Korean won to move in tandem with the Japanese yen. So again, this is not a Korea-specific problem, but it's the big trend that we see with a lot of Northeast Asian currencies. Of course, I cannot deny the fact that the Korean market has not done well. If you look at, again, the red circle, the Korean, we use MSCI Korea here in dollar terms. The Korean market is down 40% year to date. But again, if you look at other Northeast Asian markets like Taiwan, very similar performance. To me, this is because, investors are worried about global demand for consumer electronics and the CapEx cycle turning negative. So from that perspective, I think, again, this is very much to me a cyclical story rather than a structural problem for South Korea. Look, I recognize the fact that the Korean won depreciation is incredibly painful for companies in Korea, for investors in Korea, especially in local currency denominated assets. But I think, if there's any good news or silver lining, is that I personally think that South Korea's structural fundamentals is actually not in that bad of a shape. For example, if you look at our current account, this is 2021 data. South Korea runs a very sizable current account surplus. South Korea is exporting a lot more than it is importing. And also the level of foreign exchange reserves in South Korea is adequate, is high. And if I look at, for example, another pain point during the 97-98 Asian financial crisis is that South Korean companies, a lot of Asian companies were borrowing heavily in US dollar, and the foreign exchange mismatch, when the dollar strengthened, when the local currency weakened, it bankrupted a lot of companies back in the late 90s. Today, companies, I think, the level of foreign debt or US dollar debt is much more manageable, and companies are doing a better job in matching their assets and liabilities to reduce the currency mismatch. So from that perspective, I do recognize that the cyclical pain from the Korean won depreciation is real, but I would find some comfort in this is not a structural problem for South Korea or for most Asian economies, and therefore I do think that the risk of a IMF crisis it's still relatively low. And maybe the final point, I know I've taken a lot of time, a couple of things in terms of policies. To me, I don't want to comment specifically on South Korea, but my personal observation is that most Asian central banks today, arguably, Bank of Korea, they do have much better credibility with international investors. As you all know, the Bank of Korea was one of the first central banks to start raising interest rates in Asia. And I think, again, its communication with the markets is pretty clear. Its communication with international investors, at least from outside of Korea, it's in pretty good shape. So if you look back to the UK problem that I talked about just now, it was a crisis of confidence and credibility. It wasn't a currency crisis for the UK. And for me, the important part for both the central banks in Asia and governments in Asia is for them to remain credible to investors. And in that sense, I feel Korea is in pretty good shape. In terms of investment strategy, I mentioned this a little bit earlier. I think we could still see a bit more volatility in the near term. And therefore, we do recommend investors across Asia Pacific to focus more on low volatility assets, such as fixed income, such as government bonds. I think, while the Fed is still raising interest rates, I think the interest rate cycle in the US should come to a peak in the first half of 2023. The Fed may not be in any urgency to start cutting rates in 2023, but at least government bond yields should peak at around 4% for 10-year US government bonds. So from that perspective, I think a lot of the duration risks or bond price risks in US government bonds is already being reflected, but I don't think a lot of the risks in equities is being fully reflected yet. So I do think there could well be still a bit more room for equities to correct, but from fixed income perspective, I do feel more comfortable. But one thing to bear in mind also is that, I spent a lot of time talking about economics and fundamentals, but market also think about liquidity. And again, when I talked about the UK situation with pension funds, some of these are technical aspects, liquidity aspects that could still keep volatility high. So to me, it's also about not thinking about just investment risks, but also about some of the liquidity issues that investors will need to take into account. Final point is whether Korean equities are attractive. Again, I've highlighted valuations as of the end of September, so a few days ago. Korean markets, it's cheap. Both price to earnings and price to book, you can see they're trading below a 15-year average, but it may not be immediate for the Korean market to rebound. We think the Korean market will rebound once the global capex cycle start to stabilize, the US, European economy will come out of the slowdown or come out of the recession, and that will require a bit more patience. So if you are a long-term investors thinking about the next 2 or 3 years, to me, this is a very interesting entry point for Korean equities and arguably for a lot of Asian markets, including China. But if you're thinking more about the next 3 months, or if you're very sensitive towards equity price volatility in the short term, then I think you can afford just to wait a little bit longer, especially when the global markets can still go through some volatilities. So thank you very much for your patience. Unfortunately, I may not have a lot of good news for you today, but I think the important point is that what we've experienced in Korea in the past 9 months, you are not alone. We've seen very similar performance in many parts of the world, in many parts of Asia. The important point is that many structural fundamentals in South Korea is actually in good shape, but there's no room for complacency. I think the authorities, policymakers will have to continue to communicate with the markets and remain credible. I think you are starting from a position of strength, and maintaining that is always easier than what you've seen with the UK government, which is lose market confidence and then they have to come back to regain that. That's always going to be much more difficult. So the good news is that I think Korea is in good shape, but I think we have to be ready for more market volatility going forward. So that ends my part of the presentation. Thanks again for your patience. Maybe I'll hand the time over back to Dr. Jun. We can discuss more in the Q&A. Thank you.
Okay, thank you very much. Thank you, Tai, for your enlightening opening presentation. Now we have about 30 minutes left. Typically, we first invite dedicated, designated commentators. We have outstanding commentators, 3 invited commentators today. First, let me introduce Dr. Jang Young Lee. Dr. Lee is a former senior deputy governor of a financial supervisory service, that is a watchdog, financial watchdog here in Korea. He's currently a senior advisor at Kim Chan, Korea's leading international law firm, as you know, Tai. In the past, Dr. Lee served as economist at IMF, among other prominent posts, including the presidency at Korea Banking Institute. Dr. Lee, you're on. Your comment or question, please.
Thank you, Mr. Jun, for inviting me. Am I clear? My voice is clear? Can you hear?
Yes.
Okay. Thank you, Mr. Tai Hui, for your excellent presentation, which is very clear and also sounds very convincing. I want to raise just the 2 questions regarding your presentation. Starting from your statement that impact from high interest rate will come later. But the other day, I saw the US labor market data, which shows the job openings dropped sharply in August, which suggests that labor market is starting to loosen. So can we interpret from this as a first sign of US economy grappling with high interest rate aimed at dampening demand? In other words, business confidence and consumer confidence are beginning to tame down the labor market activity. And can you also infer from this, the US Federal Reserve may back down from the renewed commitment to fighting inflation, whatever the cost? This is very important for Korea. And secondly, looking at the Asia region, how do you see a current economic situation in China and the outlook for its currency, Chinese renminbi? This has also very important implication for Korean economy and its currency, Korean won, because Korean won shows a very high correlation with the Chinese renminbi and also with Japanese yen. And related to this is your view on Bank of Korea's monetary policy stance. And Governor Lee, as you know, who is a well-respected governor, has been very effectively communicating with the market by providing so-called forward guidance. And the market has been expecting a 25 basis point hike each in October and November toward 3% or 3.2% target in January next year. But recently he changed his statement by saying that the basic assumption behind this forward guidance has been changed. So do you expect the more hawkish decision in October Monetary Policy Board meeting this month? Thank you.
Thank you, Dr. Lee. Some excellent questions. So maybe I'll address them one by one. Let's start with the US. I think you made a very prompt and correct observations on the US market, or sorry, US job market. In fact, I don't have that in the deck today, but we monitor a number of macro indicators of the US. Obviously, we monitor a lot of indicators, but we did notice that corporate spending, if you look at, for example, the ISM new orders, sorry, the ISM manufacturing index, the new order component, that has been coming off quite sharply since the start of the year. So you're absolutely right that companies, first of all, they are slowing down on their capex because that's the first thing they can slow down.
Yes.
And I think the job market is starting to reflect. Now, the data you referred to earlier that came out, I think on Tuesday, so the number of job openings, I think, went from 11 million job openings to 10,
Yes.
which was a very sharp decline. I think the numbers may be a little bit exaggerated because it counts a lot of the job postings on the internet, on public forum, and sometimes, one company for one job may appear multiple times. So the decline of 1 million, it may not be 1 million jobs, it may be still a very large number, 300, 400 million jobs that posted 2 or 3 times. But I think, if you listen to a number of companies, I can't name names, but I'm sure you've all heard, some of the social media companies, some of the tech companies, they're slowing down hiring. My personal observation is a lot of the financial institutions in the US are also slowing down hiring. So I think the turnaround in the job market is already happening. But again, we saw from the ADP number last night that I think there was still about 300,000 jobs being created in the month of September, and we're going to get a new round of non-farm payrolls on Friday. I think those numbers will still show solid job growth, but I think your point, your implied point that the job market will slow down, I completely agree. And always we argue that the job market in the US is a lagging indicator, not a leading indicator. So the economy may already be in slowdown mode before the job market reflects those numbers. Business confidence, absolutely. Again, we monitor those and they have come down. It's not surprising because if you are a company with a non-investment grade credit rating, your borrowing costs have gone from 4% at the start of the year to 9% today. Of course, the good news is they've got a lot of cash. They don't need to borrow now, but at some point down the line, they have to face a much higher borrowing costs. If I'm a CEO, if I'm a CFO, I'm going to say, well, I need to make sure I preserve my cash much more carefully, which means, again, less investment and less hiring. Is that going to force the Fed to back down? This is an excellent question because my view is that the Fed today, because you can argue that they were late in hiking rates. They allowed inflation to run to where we are. They need to rebuild that credibility. So I think a key theme of my sharing today is about policymakers' credibility. And the Fed's credibility in some ways have been weakened because they left inflation run too hot for too long. And therefore, right now, they say, as you rightly said, they need to cool the economy and bring inflation down at all costs. Otherwise, they're going to let inflation run away, run small. But my concern is that the economy will cool down too much too fast in 2023. And that, to me, could potentially prompt a turnaround by the Fed. Again, if you look at the Bank of England, they are still looking to raise rates in the short end. But because of market turbulence in the gilt market, in the UK bond market, they have to intervene. So I think ultimately central banks have to juggle between economic and price stability and financial stability. And the Bank of England was a perfect example of trying to balance between financial stability in the government bond market and then the economic stability in terms of high inflation. China. I am actually not that pessimistic on China. I think there are three major issues right now. One is obviously the property market. We've seen government policy shift. I mean, frankly, this is another topic. It's worth another hour of discussion. The government's view on property is shifting from as a financial assets to a social commodity. And that has long implications for the Chinese economy. Second thing, obviously, is business confidence and then consumer confidence. And a lot of that is because of COVID policies. So I think, if the government wants a quick fix to the economy, of course, the one thing they can do is to adjust their COVID policy, be a little bit more flexible, a little bit more pragmatic. I think that to me will make consumers and businesses much happier, and they will be more willing to spend. And that will actually help the property market too, because right now the job market in China is in quite a difficult shape. And if I think a switch in the COVID policy can help to improve that sense. The renminbi, if you look at the currency, again, the weakness of Chinese.
Sorry to intervene. We have two more outstanding discussions waiting. So could you speed up your answer to the question raised by Dr. Lee?
The renminbi, I think, will follow the big dollar trend, because if you look at the People's Bank of China, the renminbi is managed according to a basket of currencies, and that trade-weighted basket has been pretty steady. So if the dollar strengthens a little bit more, sure, the renminbi will depreciate a bit more. Likewise for the Korean won. Final point on Korea. Look, you are the experts. I'm the outsider. I think in the near term, you may see a bit more urgency for Asian central banks to raise rates, because obviously the currency depreciation is one thing, but if we are looking at a recovery in domestic demand because of relaxation in COVID policy, that could also offer a bit more domestic-led inflation. So I think in the near term, there may be a need just to accelerate a little bit in terms of policy rate tightening.
Thank you.
Thank you.
Thank you. Thank you, Dr. Lee, also. Let me now connect with Professor Namu Ri at the Graduate School of International Studies at Yonsei University. Professor Ri has a very extensive financial industry experience, ranging from Asia Pacific head of Merrill Lynch and Nomura Securities to more recently president of Taurus Investment Securities in Korea. So here we go, Professor Ri. But you are better known as a financier rather than professor. So, but anyway, the topic today is just for you.
Okay, well, thanks very much, Dr. Chun, for arranging a very interesting conference call. And Tai Hui, thank you very much for a very interesting presentation. I'm a retired banker now with Yonsei University, but I did work for JP Morgan in Hong Kong in the 90s. So back then we had only 3 people in the Korean office, 1 investment banker, 1 secretary, and 1 driver. So our Korean business has grown significantly. I have a very simple question. It's about the risk, and you spent a lot of time talking about the risk, and I think we could classify risk into 3 things: known, known unknown, and unknown unknown. You probably know what Rumsfeld, former Secretary of Defense, described when he was having a war in the Middle East. So, you know, the U.S. inflation trajectory known, and some of it's known unknown. You know, but we have some idea that these risks will create a lot of volatility in the financial market. But what would be the unknown unknown for us to really think about? I know it's not an easy question, but I'm sure you had some thought about it, and it would be very useful. Thank you.
Okay. Thank you very much for your brilliant question, Tai. You have
Look, again, this is an hour worth of discussion, but I'll cut it to 5 minutes, 2 minutes. Geopolitics, extreme weather conditions or extreme weather events, and domestic politics. So I touched on domestic politics a little bit earlier. Geopolitics, we've seen Russia, Ukraine. I think when it first started back in February, we were looking at a much more localized, contained conflict, but obviously the repercussions via the energy market was very significant. Other potential flashpoint, obviously, in Asia, the US-China relationship has always been strenuous. To me, I would think that both Washington and Beijing, they are sensible. I know they want to compete, but they also want to avoid full-scale conflict because that will be incredibly damaging for all sides, not just US and China, but globally. However, quite often in history, we see that competition, tension could escalate not because of deliberate attempts, but because of accidents. So, what could be the accidents that could lead to an escalation in tension between US and China? I think that's something we have to consider. Extreme weather events, it's something that we rarely talk about. But if you think about what happened this summer, we had droughts. I know that Korea had very, very significant flooding. Hope everyone was safe. But this obviously kicks into economic activities. If river runs dry, it's not just about water availability, it's about transportation, shipping, it's about power generation. What if we get a very cold winter in Europe this year when they're already facing significant energy shortage? So, unknown by definition, we can't tell. We won't be able to know. But if I just look at what happened, even just in the last 12 months, geopolitics, things are getting very, very tense in many parts of the world. If you think about extreme weather events, that will have economic and financial ramification. So again, the example with the UK was a policy by the government created stress in the bond market, created stress in pension funds. Could an extreme weather event create something similar, for example, hypothetically, for the insurance industry? So I think, the key for me is to think about what could be the trigger that leads to financial stress. And I think geopolitics and, climate change more broadly are the two obvious candidates at this point.
Okay, thank you very much. That's an excellent response to a brilliant question from Professor Lee. Any follow-up you'd like to say something?
No, I think that's very interesting thought about the potential risk that I was not really fully aware of your concern about the weather, extreme weather, and I'm sure that's a pretty valid concern. Thank you very much.
Okay. All right, thank you very much, Professor Lee. And now, last but not least, we have actually the order of our discussants depended solely on the age. So from the senior to less senior. Now, I'm happy to invite Dr. Daniel Shin, Managing Director at MCM Group. Tai, you may know that MCM is widely reputed as an international luxury brand. Dr. Shin is also a venture capitalist and has served in various executive and board positions at KT, CJ, and Daesung Group, among others. He was nominated as a young global leader in 2016, if I remember correctly, by the World Economic Forum. Daniel, always my favorite speaker from our side. Thank you. Floor is yours.
Okay, thank you, Dr. Jen, and hi, Tai. Thank you for engaging conversation. I really learned a lot. Pound and foreign currencies synced and market tremble as investor question huge tax cut from the UK, as you rightly said. I'm not sure if Liz Truss and Kwasi Kwarteng, whom you might have studied together around the same time at Cambridge, were in full agreement. But the sudden UK tax cut attempt was not really funny at all, although it might have been really necessary to the UK. The UK has partially ditched the controversial unfunded tax cut for now, and the market positively reacted to that, I guess. But the overarching problem is that growing pressure, especially from utility bills in the UK or in the entire EU nations, persists right now. If the war between Ukraine and Russia is prolonged over this winter, my assumption is directionally other countries may need to enact similar quasi-subsidies or drastic tax cuts to sustain the safety net of their ordinary citizens under heavy inflation pressure. So that can be pressure point to the global economy or trigger for another massive global financial crisis, if I make sense here a little bit here. So that said, what's going to happen? Winter is coming, but it does not really end soon. And how can business weather this increasing market volatility and Asian financial crisis alike event signals, especially around foreign currencies right now? What is your view on that, Tai?
Yeah, thank you. This is a tough question. Maybe I'll just put it in two parts. The first part is you touch on a very important point, and that is expansionary fiscal policy, not by choice, but by necessity, because people are going to freeze in Europe, literally, if they don't get subsidies. And that, to me, is a very important point, because we spent a lot of time just now talking about the Fed and other central banks raising rates aggressively to fight inflation. But higher rates also means higher interest burden for governments. So at some point, when the debt to GDP level of developed economies like the US and Europe start to rise, central banks will need to take into account of that high interest burden. And that's why myself and my colleagues in JP Morgan thinks that ultimately in the long term, central banks will have to keep rates low in order to allow for governments to make their debt affordable. Japan's a great example. I don't think in our lifetime, Japan will be able to raise rates meaningfully because of their government debt to GDP level is over 200%. So I think you touch on an important point, and that is when governments are facing huge debt burden, central bank raising rates, that is going to create potential flight to quality for some central banks, or for some investors. And that, to me, it could actually be potentially an opportunity for Asia, because our debt to GDP ratio is manageable. We are actually much more disciplined compared to the US and to Europe and many developed economies. In a way, we are in a better position structurally than many developed economies. So in that sense, I share your concern about global market volatility, because often it's not our fault. It's what happens in the West that creates the volatility and the waves that impact on our markets. But as I mentioned earlier, I think, yes, we will see volatility, but the fundamentals of the Korean economy, the government's balance sheets, the current account is in a good position to weather some of the shocks. But I do think we need to be more mindful about how we further reinforce our balance sheets, whether it's the households, the corporate, or the government, in preparation for this volatility. Because ultimately, again, it comes back to my earlier point. Politicians, I think UK is a great example. They have their ideas, but sometimes it may not be economically sound. It may not be what the market expect. And that could be a source of volatility, especially, I think, coming out of Europe. Because in the US, at least you've got the government, the president and the Congress, potentially in different parties, that act as a brake, I think, to slow down fiscal deficits. But in Europe, typically you've got the prime minister running the country, and they can implement whatever policy they want. And that, to me, is actually quite a risky structure from a policymaker standpoint without the right checks and balances. I think that, to me, was the whole issue with the UK. It was the lack of checks and balances when the government announced tax cuts, and everyone just panicked. So again, I think credibility is, to me, if there's one thing everyone should take away today, is the value of credibility of policymakers and central bankers, which I would argue in many parts of Asia, we are probably in a good shape compared to what I've seen in the West.
Okay, thank you very much. Daniel, is that okay?
Thank you.
Okay,
I learned
thank
a
you,
lot. Thanks a lot.
Daniel, for your participation and in this webinar. Appreciate that very much, and thank you, Tai. Now, we have about 5 minutes plus, as I understand it. We'll be happy to extend our conversation by about 10 minutes. But thank you very much for that, because I have few questions and observations that I would like to share with you for next 10 to 15 minutes. Now, just very briefly, now, the kind of favorable market development over the last 2 or 3 days. Now, how should we interpret this? Is that the beginning of the end of the bear market, or is this just another dead cat bounce? You tell us.
That's a $1 trillion question. I don't think this is necessarily the end of the bear market, because we have not yet seen a more comprehensive set of data coming up from the US, thus telling us the economy is decelerating. So, in a sense, I think the first question by Dr. Lee was really interesting and really important, because what's going to change the Fed's mind? For the equity market or risk assets to really start to take off again, we need to see at least some signs of the Fed nearly done with their policy tightening. And that becomes a dilemma, because if data stays strong, the Fed keep raising rates, market will still correct. And when the data start to weaken, that to me is the first step for the Fed to start to climb down on its hawkish stance, and then the market can start to repair itself. So we may not see a lot more correction in the market. The timing of the market, as you know, is not possible. But I just think that we probably need a little bit more time for data to start to weaken, for the Fed to indicate that the hiking cycle is coming to an end. That to me will be much more reassuring as an entry point for equities. Now, that said, I did mention this again in my presentation. If you are an investor that is less sensitive to price volatility, you only think about the next 2 or 3 years, sure, by all means, today is not a bad time. Valuation is attractive, markets come down a lot. But if you are, and frankly, there are not that many investors who can be that rational. We all are influenced by market volatility. But if you're a little bit more sensitive towards market volatility and potential correction, I think we can afford to just be a little bit more patient rather than pick the exact bottom of the market.
Thank you very much. I appreciate your comment, response. Now, a few questions more directly focused on Korea. First, now, throughout this year, especially for the first half of the year, we have seen a huge capital outflow from Korean market. So there's exit of foreign investors away from Korean market. Now, recently a bit more stabilized, but the things broadly overall this year was a bad year with respect to attracting foreign investment inflow into our market. Of course, macro factors, global issues, factors behind. But in your view, from the perspective of international financial community, investor community, what can Korea do better?
Yeah.
to raise the appetite of international investors in Korea?
I get this question a lot across Asia. If I travel to India, if I travel to Taiwan, to Southeast Asia, capital flow, rightly so, is on a lot of investors' minds. For every market, I start with the same comment. It's not personal. It's not just South Korea or India or Taiwan. We've seen capital outflow across both APAC markets and emerging markets. And one thing I want to bring up is, if you speak to a US investor, an institutional investor, they don't think, oh, I'm going to allocate just in Korea or just in Taiwan or just in China. Quite often, they will think about US and the rest of the world, or US, developed markets, emerging markets. Of course, there are investors who are much more sophisticated who look at individual markets. But a lot of the investors that we speak to in the US, they think US and the world. So when they pull money out, it's not just South Korea, it's from their rest of the world allocation. But obviously, I think South Korea had a tough time because the South Korean market is very focused on technology, very focused on exports. And when the US and European demand is starting to slow down, that created the additional pressure on the markets. And again, you saw earlier on, it's not just South Korea. Taiwan had the same thing. So what's going to turn that around? Maybe I use an example of building a campfire, right? You've put all the logs in place. You build a log, but you need that spark. You need that tinder to set the fire going. I think from a valuation standpoint, Korean equities is already looking attractive. So the woods, the firewoods is all built up. You need a spark. And that spark is going to be two things. One, it's for the global economic outlook to look more constructive. So it could be purchasing manager index in new orders, semiconductor demand. And also the other thing is for, this is more specific for technology, for inventory to start coming down, because then pricing will start to pick up. So global capex cycle relates to technology, relates to automobile, which obviously is a big industry in South Korea, shipbuilding, chemicals, all of that is the key core industries for South Korea. But on top of that, one thing we did see is the buildup in inventory in the electronic sector. That again created additional pressure. So you need the economy to fix those problems for investors to start to look more optimistic on South Korea and arguably in many parts of Northeast Asia, including Taiwan.
Okay, thank you. Appreciate that. I just got a question through our chatting room. Let me read this question for you. This is from Professor Won-hyuk Lim at KDI International Graduate School. He's a professor there. Looks like this question is related to UK episode that you have talked about. You alluded to liability-driven investing, LDI, as a hidden danger. In your view, what are other potentially risky derivative products that could destabilize the financial system if bond rates jump or exchange rate cross some threshold?
Excellent question, and I wish I have an answer for that, but we are doing some work on this at this point. But maybe I'll make one comment on this topic. Financial institutions, whether it's insurance companies, pension funds, endowments, they've been living with a zero yield environment for a long time. And therefore, it's been a challenge, right? They have to provide return to their clients, to their investors, with very poor yield in the markets. So LDI, I think, is one example of financial engineering initiatives or innovation that helps financial institutions to address these issues. Now, I must confess, I don't know what else is out there at this point that will be similar, but I'm pretty sure that many financial institutions have also deployed similar derivative-based strategies to match their assets and liabilities. I think that would be a good place to start in looking at how does a rise in yield and decline in bond price or asset price impact on these strategies. And also, it's not just the decline in price, it's the speed, because it was not about gilt price coming down. If it came down very slowly over weeks and months, it wouldn't be an issue. It's coming down in such short space of time that triggered the problems with the LDIs. So sadly, I do apologize, I don't have an answer for your question, but I think that's how I would think about this challenge of what could be next. It's financial institutions been handling low yield environment, their strategies, are they vulnerable to sharp movements in prices?
Okay, thank you, Tai, for your feedback. Since we talked a lot about UK episode throughout this morning, I feel obliged to say something about it. That is that I may be a minority thinking this way, but I feel a bit, I must emphasize, I feel a bit sympathetic with those UK Chancellor, Prime Minister, under tremendous stress over the last couple of weeks or so. Now, I say this because tax cut is clearly with good intent, because if you look at British economy, the trouble spot is this continued decline in productivity. Now, to revert the situation, of course, reverse the trend, they have to give incentive to corporate sector to make investment and raise productivity. So tax cut is clearly intended, where someone may put it as a Reagan economics-like approach at that time. But anyway, the good intent, but perhaps bad timing and coordination, lack of coordination. That's a pitiful part, because market was already nervous about the shaky fiscal position in the UK now, and in that kind of a very fragile environment, any sort of policy change in a big way, which could, at least in the short term, undermine British fiscal position in wrong direction, then of course market would react very badly. On top of this pension-related issues that you alluded to, that's another thing, because when you introduce new policy measure, you have to think about how that would be related to other actors and other issues in the market. So that's, but I feel a bit sorry for the way they have been treated very hard. Now, before I let you go, I would like to ask at least one more question that has to do with the early question that on Korea's efforts to make the market more attractive. Along that line, as an extension of that, actually, now Korea, especially capital city Seoul, has had a long aspiration to become a very competitive international financial center, which is good not only for the city, but for the country and for the financial sector competitiveness around the world. Now, things a bit changing with respect to the sort of a ranking of international hub. As you know, lately, may not be good news for you residing in Hong Kong, but Singapore has overtaken. There's a story. I don't know how credible that survey may be, but Singapore has overtaken Hong Kong. It's the number 3 spot after New York, London, and Singapore. And Korea, South Korea's capital city Seoul has also moved up close to 10, now 11 rank, and they figure that growth potential wise, Seoul topped the ranking. So we have some lights, we have a more encouraging environment, hopefully, to make any headway along that line. So my question to you is that from international financial community perspective, what would be the most important things that Korea and cities like Seoul or even Busan,
Well, first of all, I think,
like to improve to be more attractive international financial center?
I think first of all, for that survey, look, there's no doubt that Singapore has been making very good progress in the past few years. Although I do dispute the results. For example, they've got Washington, D.C. above Tokyo. So I never knew that Washington, D.C. was a financial hub, but never mind. That's the survey. But more seriously, I think for me, a financial hub is imagine a river. You're basically collecting the water from the mountains, from a watershed into the river, and a financial center is the mouth of the river. So the question I have for any financial city that aspires to be a financial hub is your watershed, the collection area, big enough to allow business and capital flow to congregate in that city? So for example, Singapore, it's Southeast Asia, increasingly the rest of Asia, collecting IPO opportunities around the region. Hong Kong has always been China's front when it comes to financial services. I think Seoul's positioning on top of obviously serving some very large, very successful Korean companies, could they broaden it to be a conduit between the West and Asia? That's obviously one clear option. Or the rest of Asia, whether it's Japan or China or other parts of Asia. I think having traveled to Seoul on and off a few times a year for the last 20 years, I definitely can sense the development of the financial industry. But I think it serves the domestic demand very well. But I think future progress will have to involve the international community or the international business community in order, to broaden your watershed. So look, I think a lot of the policies are moving in the right direction, but it's about broadening your horizon and your collection area beyond South Korea into other parts of Asia, or as a conduit between the West and the East. I think that's the only way for any city to be an Asia financial hub.
Thank you very much for your very helpful thoughts. I'm sure the authorities in Seoul and the cities in Korea, the government would appreciate that. Now it's time to close. Before I close, perhaps I may say a word or two, just recapping what you have said in the early part of your presentation. That is that I was very much encouraged by your statement about Korea. As for Korea, bad news have been pretty much priced in, so that is good news. And another good part is that the current government authorities and BOK officials are very much seasoned, experienced, learned from the previous experience with the past crisis. That's another good thing. So that's encouraging point. But also, you mentioned very correctly that nevertheless, this is no time to be complacent. So that message has to be taken seriously. And another important point that I do want to repeat before I let you go, that is that if you look at globally, no country is exceptional. When you face this very crisis-like situation, the populist policies tend to come out, tend to thrive. You mentioned Italy, but many other countries, in similar situations. So clearly, to cope with this current economic and financial threats successfully, we need to make every effort to avoid temptation to exercise and pursue populist policies for the good of the country and people. With that, I would like to thank you very much for a brilliant presentation and a stimulating conversation today. And your thoughts will be followed up by our next speaker in 2 weeks. Professor Ken Rogoff will talk more about the policy issues in greater depth. Thank you very much, and hope to see you again soon, next time, perhaps in person rather than just virtually. And I would like to thank our audience for participating in our webinar today as well. Thank you very much.
Thank you.